Park Place Investment welcomes you to another episode of Investment Cubed, where we talk about the world of commercial real estate and real estate financing, Silicon Valley and technology startups, and investment and personal finance.
Hi everyone, I would like to welcome you back to another episode of Investment Cubed. Today we have the president of BV Capital, Rob Anderson, here to discuss his company's amazing income-producing real estate fund. The fund, with properties located all over Texas, aims to deliver stable tax-advantaged monthly income to investors through direct ownership in a diversified portfolio of income-producing real estate. The fund is designed to share profits with investors upon liquidation of the assets in 5 years. Rob oversees operations and direction of BV Capital, which is a member of the Bridgeview family of companies. As a licensed expert in the securities and real estate industry, Rob has over 20 years' experience actively seeking diversified investing opportunities.
Well, the firm's got probably 20 years of experience in real estate. I mean, me personally, and probably like a lot of folks, I read Rich Dad Poor Dad 20 years ago and started buying rental houses, right? I ended up getting 4 or 5 of those and vacation homes. And next thing you know, I'm floating 5 mortgages. And, you know, like a lot of people find out, it ends up becoming another job. And I already had a good job. I didn't need a second job. And then I discovered the beauty of passive real estate investing, where you invest in a private commercial deal, and you let the professionals do the job, and you sit back and you make probably better returns than you were doing on your own, and you don't have to lift a finger. So I found that and fell in love with it, and I've been doing that for myself for the last 10 years. So there's a short, I guess, answer for you. It could be anything from, like I said, I started in single family and then vacation rentals and gravitated into multifamily, large multifamily office, a lot of commercial real estate. We're doing industrial now. We got a mixed use development. So it's come a long way. So I guess a little background is I'm actually from the securities industry. I've been securities licensed since the 90s. And I used to sell financial products to every firm you can think of: Merrill Lynch, Morgan Stanley, UBS. Those are my big clients. And so I've been in the investing. Well, I've been an investor ever since. And you know, as I mentioned earlier, starting to invest in passive real estate, I just never found better deals. I never found better returns. And now you have to be an accredited investor. But what's interesting is 14 to 15 million households in the United States qualify as accredited investor. In fact, that number probably went up because they just made a change recently. However, what surprises people is less than 1% of those people have ever done a private real estate deal or a syndicated deal, to your question. You really had to be at the right country club or live in the right zip code for these deals to ever come and be shown to you. Otherwise, you'd never know they exist. You never get the opportunity. So sadly, up until now, there's been this great exclusivity on these type of deals. And I'm a big fan that shouldn't be the case. If you qualify, you should have the opportunity to grow wealth just like everybody else. And so I had the opportunity to find this about 10 years ago, and I really enjoy being able to bring that opportunity to other people, as you guys are doing at Park Place with the crowdfunding. So back to your question on syndication, we used to use private equity to fund our deals. We used to use institutions to fund our deals. And we've become a much bigger fan of just letting individual accredited investors come in on a passive basis and fund our deals. We give them something they can't find on their own typically, and to us it's irrelevant. We enjoy working with the individuals better than the institutions. Why? Most individuals are just excited to be part of the deal and they want to learn. And we do a lot of education. The institutions think they're smarter than you and they try to tell you how to do your deal. And some of them may be, but most of them aren't. So we prefer to go the syndication route. I apologize. That was a really long answer for you, but hopefully that was what you're looking for. So we've done both. You know, we've done plenty. We call them single asset, deals versus a fund. The fund structure simply allows you to do bigger, right? It's more about diversification. So our current fund's going to have anywhere from 12 to 13 different properties in it. So you get diversification of geography, diversification of industry, you get diversification of sometimes product type, and that's really what it is. Single asset deals are great. We love them. We do them all the time. I've invested in them, plenty of them. You got to realize if you're invested in one deal, your deal is as good or as not as good as that one deal, right? And so that's kind of the thing. So The same reason that mutual funds were so popular is it's a basket of stocks, so you're more diversified is the argument, and it's a good argument. The same thing is true here with a fund. The only difference with a fund is that it gives you your return isn't solely based on the performance of one specific asset. So if you're going to do a single asset deal, you better fall in love with that asset and really have massive conviction about it. If you're just looking to accomplish something, then you might want to look at a fund. I always look at an investment differently because keep in mind, I'm an investor. I'm not a real estate person. I just love real estate as an investment. And I look at what is the money designed to be used for? Is this retirement money? Is this college education money? I just want to grow it because I love seeing it go up and I get excited about it. And we get that too. What are you trying to do with this money? And that's how you should look at where you allocate it, right? I find a lot of real estate investors jump into the same type of deal over and over and over and over and over again. Well, the reason you went into real estate in the first place most likely was to diversify from the stock market. And if you keep investing in the same thing over and over and over again, you lost your diversification. So forgive me, I'm going on and on with that, but that is really the main difference between a single asset and a fund is, the single asset, you're as good as that one asset. Now, the other side, the flip side of that is you get to see all the financials, you get to understand every single little nook and cranny about that one particular asset. Where on a fund, it's more blended. You don't get as deep on it, and you're hiring a portfolio manager or a team or a company like ours to run it. So to segue into what we were doing, as we've done a lot of single asset deals, we've done multifamily, office, mixed use, all kinds of stuff. We fall in love with the industrial area. Why? Industrial is the blue chip of real estate right now. It's the safe space. It's the hot space. It took zero pullback. In fact, it's growing. Why? We all know these reasons. E-commerce has exploded, right? We have e-commerce. We have order from home. We're ordering everything from home, right? Whether it's not just Amazon, but also our groceries. So you have that. You also have manufacturing coming back. You have what they call onshoring, where people had manufacturing offshore, and now they want to bring some or all of that back to the United States. And you've got a lot of these warehousing, distribution, manufacturing type opportunities that are around the country. And what's funny is there's so much e-commerce boom in warehousing that it ate up all the warehousing space. So if you're going to onshore business back to the United States, you actually have to build a new warehouse. You've got to build a new manufacturing facility. So we're seeing a lot of what we call build-to-suit opportunities. Let me step back for a second. What we were trying to solve for was a problem. And what's the problem? The problem is there's no yield in the market right now. The Fed took the interest rates to near zero. What does that mean? That means the bond market is basically useless. It doesn't do anything for you. The reason you go into the bond market from the stock market is to reduce risk, to take a risk off the table. And in exchange, you might not make double-digit returns. You might make mid to high single-digit returns, but you're in a much safer position, right? As people get close to retirement, they generally will load up more on bonds and less on stocks. As any financial advisor will tell you. The rule of thumb used to be the percentage of bonds you should have in your portfolio is your age. I turn 45 next week. That means 45% of my portfolio should be in bonds. I can tell you right now, that's not the case. The bond market is basically useless. There's no yield on the markets. What we were trying to do is help solve for that problem. We wanted to create yield without adding massive risk. So a lot of people ask me, because we own a broker dealer, so we're registered by FINRA, so we're not your normal real estate shop. We've got extra layers of fiduciary duty, if you will, that we have to satisfy. So I get asked a lot of financial questions. People go, why is the stock market where it is when we're in the middle of a pandemic? I mean, it's high. The stock market is higher now than it was before COVID. How is that even possible? And so there's a disconnect, and there's something called the TINA effect. And TINA stands for there is no alternative. And a lot of folks think there's no alternative because the bond market is useless. What else are they going to do? They don't have access to real estate, or maybe they haven't found how to have access to something, and they just go to the stock market. The stock market goes up. That's one reason it's so overvalued right now. So it's an interesting effect that's going on. However, back to what we were trying to do is we're trying to create yield. We're trying to create an alternative for you. So diversification. Not only that, the beauty of real estate is it's tax advantaged, right? So on our yield, we do it as return of capital. So in return of capital, you pay zero income tax. So our deal is 5 years long. So whatever you put in, you get 7% back. That's the preferred return. It's coming off the rent of the properties we're buying. I'll get into that in a second. And so basically that is income tax free. And at the end of 5 years, you pile up all your K1s with all those passive losses, and to do your taxes after 5 years, you pay a long-term capital gain. It's a fantastic way to invest from a tax advantage standpoint. So once again, we were trying to accomplish yield. So what we did is we got triple net leases. A triple net lease means the tenant is responsible for 100% of what goes on in that property. Maintenance, taxes, insurance, upkeep, everything. Now, the only way you do that is you have a single tenant. You have to have a single tenant. And what we look at is the credit quality of that tenant. What's the likelihood that they're going to be able to pay the rent, no problem, for 5+ years? Because we want to get out in 5 years. We want to package up 12 to 13 excellent properties and sell them to a REIT or a large institution because they're dying for this stuff. So what you guys get to do as investors is you get to participate along the way. We're paying a 7% yield off of the rent in these properties. 100% of the properties that we're going to put in this fund can pay that 7% out of their rent day one. I don't have to push rents. I don't have to create any value add improvements. I don't have to do anything. And so what we're looking for are companies that are going to perform well in a post-COVID world. Let me give you an example. Floor & Decor is our first property we're going to take down. Not exactly your stereotypical industrial warehouse. Floor & Decor has been a fantastic offer. There's 3 spaces of retail that have made money: e-commerce, grocery, home improvement. Home improvement has crushed it. What did we all do during quarantine? We sat at home and stared at our kitchen looking at, we really need to upgrade that thing. And we went and found a contractor. What did that contractor do? He took us into a Floor & Decor and said, buy your tile. 70% of their sales come from contractors. Beautiful format. So it's really what we call showroom warehouse. It's a giant warehouse, but they also made it a showroom. So only about 1/3 of their business comes from people like you and I walking in off the street. It's a really neat concept. Long story short, it's a mid-cap size company. There's $7 billion in market cap. There's 120 stores around the country. They're a public company. You can look them up. I believe they're on the NASDAQ in New York. I can't remember, but you can look them up. They're public. And this is a great credit to have, right? Because they're going nowhere. They're in demand. Their sales are actually up year to date. 5 years from now, and we're buying that at a discount because they were deemed essential. If you're deemed essential, your value just went up overnight. A year ago, we never even used that term. But that's what we're looking for, stuff like that. We've got manufacturing. We've got another interesting property I'll tell you about is our Loomis Armored. Loomis Armored are the big trucks that go into the banks and they empty out the ATM and they take it off site. What's interesting is bank branches don't have vaults anymore. I don't know if you guys noticed this, but look, there's no bank vaults in any bank in America almost. Why? They've outsourced that to people like Loomis and Brinks and other folks. And so we have a Loomis Armored facility that has to meet Department of Defense standards. What we love is a property that is with a good sized company and it's mission critical. Mission critical means it's economically painful for them to not pay their rent and go somewhere else. Well, when they've dumped all the money they got to dump into these things to create a little mini Fort Knox there, they're not going anywhere. So, sorry, that's a long answer for you, but that's what we're looking for. We're looking for properties like this that'll pay you 7% monthly. I probably should point that out. And we're gonna slowly package up over about the course of a year and a half, 10 to 12 to maybe 13 of these type properties. We're gonna hold them for about 5 years, maybe less, and we're gonna basically package them up to one of the public REITs or an institution that wants to own these. Why? Why is the exit so solid? This is important. Whenever you invest in something, you gotta understand the exit. How are you gonna get out of the deal? How we're getting out of the deal is most of these public REITs are only paying 4 or 5%. And if we can give them a portfolio paying 7, they're going to take that all day long. So they don't want to, and the other thing is they don't want to buy these one at a time, right? They want to buy packages of them. So that's what we're doing. We're going to go buy them one at a time and we're going to buy a package of it and then we're going to send it off. Okay, so it's a $50 million raise. And so there's going to be quite a few folks in the fund. The private placement memorandum will say a $250,000 minimum. And the reason is one unit is $250,000. However, for Park Place, we will allow fractional units. Okay, so it's an advantage of working with your friends here at Park Place. We're going to go ahead and offer you guys fractional units. My bare bones minimum will be $25,000. I don't know if it's really worth doing it at that level, but we have a few people that do it. It's a good way to get started if you need to. Our average investments, 50 to 100,000 for folks that we allow fractional units with, because we don't allow that everywhere. But we're going to go ahead and allow that for you guys at Park Place. Last thing is we're sticking to Texas. We live in Texas, and whoever you invest with needs to invest in their backyard because that's what you know the best. Texas has no state income tax. So if you're out of state and you invest with us, you do not have to file a tax return on your investment with us. People love that, okay? Not going to bang the drum too much, but we have massive in-migration in Texas, and we've had massive job creation in Texas, and we have massive industrial demand across where we live, especially in the Dallas-Fort Worth area. So we've had a lot of really just demand. You want to go where the demand is high, because then when you exit, you're going to exit well. So that's what we're doing. We're just creating yield. JLL is a big real estate shop in the industry, and they have called this exact offering that we've created a bond wrapped in real estate, because it's a genius analogy, because there's no yield on the market. So this is for your safe money. This is for your, this is not your roll of the dice money. Do a ground up development for that. This is my balanced fund. This is I want to have something secure, stable. Nothing is without risk, right? I'm not saying that whatsoever. But on the spectrum, this is pretty far down. So it's a very conservative play to get 7% income paid monthly, good upside at the end. You're probably going to get around 1.5 to maybe on the high side 1.9 times on your money in 5 years. That comes out to roughly 10, 11% on the low side to probably 14, 15% on the upside of an IRR. So equity-like returns for about the risk parameter of a bond. That's how I would ask you to think. It's a real good risk-reward trade-off.